Hey there, everyone. Welcome back. You are watching Inside. Right now, it's time to talk finances with Heather Foster of Foster Financial, always bringing us that good, important information. Heather, it's a pleasure to always have you here.
Always good to be here.
Yeah, today we're talking about donor-advised funds. For those who are looking at the screen right now, they say, what exactly is that?
It's highly underused, in my opinion, but if you are someone who gives to a non-for-profit, it is a way really of kind of front loading or front funding money into an account that then you donate from that account moving forward. So I'll just give you a couple of examples of ways that we save people taxes. If you gave $5,000 a year for your tithe and your offering, let's say, or for any non-for-profit giving, that's not enough to itemize. So that giving that you're doing isn't going to be enough to have you take more than the standard deduction that the IRS gives you for your 1040. However, if you're young and you had the money to fund 10 years all at once, so $50,000 into a donor-advised fund, now all of a sudden you've got a $50,000 tax write-off as an itemized deduction along with some other things you can itemize as well. So even though you're still going to give that same $5,000 out of the fund, you donated $50,000 in 1 year, you'll turn around and give that same $5,000 for the next 10 years out of the fund, but now you've gotten a tax write-off. So immediately it's pushing your income tax bracket down because you are writing off a lot more of something that you would not have been able to write off otherwise. So there's a big tax savings there. There's an even bigger tax savings for people who have appreciated assets. So appreciated assets could be in the form of stock. So you bought a stock for $100 a share, it's now worth $200 a share. If you were to sell that stock, you're going to get hit with a capital gain. But if you donated the stock instead, not only did you get the tax write-off of the donation itself, but you've also now avoided capital gains. So 15% or 20% is a capital gains rate, for example, so someone can avoid that 15 or 20%. Most people who are in the 22 or 24% tax bracket, they can avoid some of that because they've done the donation itself that allowed them to itemize. And on top of that, if you're a high wage earner and you and your spouse make more than $250,000 a year, you also get hit with something called the net investment tax. We call it NIT in our industry. So it's basically an additional 3.8% in tax on any investment income. But if that investment income doesn't exist because you didn't buy and sell and trade it within your own account, you instead donated that stock, you've not only avoided, again, the capital gains rate, you've got to itemize, which is your ordinary income rate, but you've also avoided some of that additional net investment tax as well. So what I don't understand is people, this is highly underused, as I mentioned earlier.
Yeah, this sounds like a way to get in front of the game.
It is. So I look at people and say, hey, you know you're going to be donating to your non-for-profits. You know roughly the amount that you give every year. Why would you not either front load it with cash or front load it with existing stocks? Stock options are also something that you could donate. You could decide to exercise your option if you've got stock options with in your company, and then donate those highly appreciated option prices that you have. Restricted stocks, RSUs, that kind of thing. Anything that was in your name that you have vested, you could look at potentially donating and avoid the capital gain. The other types of investment assets that have appreciation, properties. So you could actually move into a, take a real estate investment, let's say, a rental home, and you decide you want to sell it. You could donate the home, which has appreciated assets, which means that maybe you bought the house for $80,000, now it's worth $200,000. You could donate that home and avoid all the capital gains. And then that bucket of money that you funded to the donor advised fund, that's just now your giving bucket for the rest of your life. So again, just talking to people, I'm not saying you have to give more. I'm saying just utilize and look at what you're already doing, but do it in a tax efficient strategy way. And the biggest issue that I see or come across is people just don't understand it. It's not just for those high wage earners. Again, it's, even if you give $2,000 a year, but you're young, maybe you front load some extra money into it so that you can use that giving fund for the rest of your life. The other kind of asset that I like to mention is just if anyone's selling a business. So you can create shares of your business and donate shares of a company. So if it's a year in which you are selling a business, you can look at doing it that way, or just, again, front loading those donations for maybe the next 10 years. So you've got 1 year where your income is really, really high. The rest of your years, the income may be low because you've sold a business. Now that's the year to do that front loading of the donor advised fund. So it is almost a 50% tax savings sometimes for people. if they do this kind of strategic planning.
Heather, you are always bringing some really good information. And like you said, sometimes people just don't know, and they just need to ask those questions, right?
Yeah, exactly.
Thank you so much. Everyone, take a look at your screen right now. Find out much more information about Foster Financial. You see it right there on your screen. Book that complimentary consultation. Get those questions answered. Reach out. A great team over there at Foster Financial. We'll be right back, everyone.